Okay. So let's look at some examples here in Chapter 3. Again, we're dealing with adjustments. There's 4 main types. You have accrued revenues, accrued expenses, deferred revenues, and deferred expenses. So those were our 4 main types that we were dealing with. And accrued revenues are revenues that we have earned and we just haven't actually recorded them yet, okay? So in this case, with accrued revenues, if you see something, it says at the end of the current year, $17,555 of fees have been earned, but not yet billed to clients. Well, when I see that, earned but not yet billed, this is just a typical revenue recognition entry where we're billing our clients. Okay, so we're just showing that we haven't yet billed them, but we've earned that revenue in this period. So it's really just like any other time when you bill a client. So what would I debit and credit to recognize revenue when the customer is not paying right now?
Accounts receivable.
Perfect. Perfect. I'm going to debit accounts receivable for the $17,555 and credit fees earned $17,555. Okay. So anytime you see that, you know, revenue has been earned, but just we haven't billed it yet, that's just a typical revenue recognition. So we debit accounts receivable and credit fees earned. So that's considered accrued revenue. It's probably the easiest one because we've done it before, so it's not too bad. Okay, then you can always hit check my work just to make sure on that one. Okay. The second one is dealing with an accrued expense. So these are expenses that, again, we've incurred, so we owe for, but we haven't yet paid. And we may not be paying right now, you know, but if it's an expense that has incurred in the current period, we need to recognize it. That's the whole point of adjustments. So in this case, it says Prospect Realty Company pays weekly salaries of $27,600 on Monday for a 6-day work week that ends the Saturday before. We want to do an adjusting entry for wages that we owe that we're not yet paying, assuming that the period ends on Friday. So we have a work week that's actually running, you know, Monday through Saturday, and then we're paying them the next Monday. But here they're telling us the period actually ended on Friday. And so we need to look at wages that have accrued Monday through Friday only. Okay, so that one's a little tricky. So sometimes you have to really read these adjustments because it's not just about getting the debit and credit amounts or, you know, accounts correct, but the amounts right as well. So in this case, we're really looking at, we have a 6-day work week, but we just need to log 5 days worth of accrued expenses. Okay, so you're actually going to take your $27,600 and divide it by 6. That should get you like a daily amount. Okay, so that would tell us how much daily. Oh, that's freaking out there. How much did you say?
I think it's 46.
Yep, you got it. So 4,600. So then that would be per day. Well, if the period ended on Friday, we had Monday, Tuesday, Wednesday, Thursday, Friday. We had 5 days of accrued expenses. So then you just multiply that by 5. And we should get, what, 23,000? Okay. So we have a work week of 6 days, but our period ended on Friday. So we still have to calculate how much wages we owe to the end of the period. So that was 5 days worth. So we took our total, divided by 6. We got 4,600 each day, and then multiplied by the 5 days that have been in this period, because we're dealing with this period. And then what would I debit and credit that 23,000 to? Yeah, salaries expense. Good. Perfect. Yep, you guys got it. So salaries expenses debited because we've actually incurred that salary expense. And then we credit salaries payable because we're going to pay them next Monday for this work week. We're going to pay them for the full 6 days that they've worked, but we're just looking at the 5 days of salary that has happened in this period, in this accounting period. Okay. So So we debit salaries expense and credit salaries payable for $23,000. Any questions on that one? Okay, so that's considered an accrued expense. So an expense that has been incurred that we just haven't recognized yet. Okay. Alrighty, let's look at number 3. Number 3, it tells us it's an adjustment for unearned revenue. Unearned revenue is a deferred revenue. So here, if you remember, an unearned revenue is when we've received cash in advance. So they've paid us for the service or for the product before we've actually delivered it. So in this case, it tells us what happened. It says on June 1st, Herbal Company received $18,900 for the rent of land for 12 months. So when we did that, we actually debited cash because we received money. We debited cash $18,900 and we credited the liability account unearned revenue, $18,900. Okay? So we credited unearned revenue. Unearned revenue is a liability, so it increases on the credit side. And with that first entry, we credited it $18,900. And that was for 12 months of rent. Well, bless you, that was on June 1st. Now we want to do the journalized entry for December 31st. Well, 7 months have passed, right? We've had June through December, 7 months. So we've actually earned 7 months of this unearned rent or unearned rent revenue, okay? So they paid us up front on June 1st for 12 months rent. So we received the cash and we credited this liability. Now we're saying they've earned 7 months worth, okay? So I want to calculate 7 months worth of this rent. So I would take $18,900 and divide by 12 to get the monthly rate. And I'm going to multiply that by 7 months to get how much we have actually earned, which should be $11,025. Because 7 months, they paid us in advance on June 1st, and now it's December 31st. So 7 months have passed. So of the 12 months they paid us in advance, we've now given them 7 months worth of rent. So that's what we're looking at here. They paid us up front for 12 months. So we need to calculate how many months have we actually provided them, because we know that becomes earned revenue, right? Because we've actually provided them 7 months worth of rent now. So those 7 months become earned revenues. So $11,025 is debited to the unearned, I think they call it unearned rent. Yeah, unearned rent, which is our liability account. $11,025. And we're going to credit rent revenue. Okay, we're going to credit rent revenue. So the unearned revenue or unearned rent gets debited $11,025. So then we could subtract here to figure out how much, unearned rent that we still owe them, which should be 5 months worth, okay, that we still owe them that will, give them January through May of the next year. Okay. So that's considered what we call a deferred revenue. So we've been paid up front, and now we just want to recognize how much we've actually earned.
Will we count the months?
Yeah, you're going to count the months. So if they paid June 1st, you're going to start counting in June. Yeah. That's a good question. Any other questions on that one? Those are unearned rent or unearned revenue, sorry. That's a deferred revenue. Okay.
So even though they didn't receive, even though they received the cash, it still goes to unearned rent?
Yes, because what happened was when they paid, they were paying for 12 months worth of rent in advance. So we received all of their cash, but we credited the unearned rent, which is a liability because we owed them that service for 12 months.
Oh.
Okay, so unearned rent is a liability because we owe them that rent for 12 months. Now at the end of the year, we've actually given them 7 months worth of that. That's what we convert into actual revenue because we've earned 7 months worth now. Everyone understand? Sure, kind of no. Blank stares don't count, guys. It's like, I mean, you can ask me all the questions if you have questions. Okay? Okay. Okay, and then the fourth type, and again, we're going to do more practice on these, but the fourth type is what we call deferred expenses. Okay, these are prepaid expenses. So it's kind of like the unearned revenue. You know, instead of us being paid and then us owing a service, we're paying up front for rent or insurance, supplies, anything like that. And then we need to figure out at the end of the year how much of that rent we've actually used, or that insurance we've used, or supplies that we've used. So remember, with a prepaid expense or a deferred expense, we've already paid for it up front. Okay, and we recognized it as an asset, right? When we buy supplies, we debited supplies and credited cash or accounts payable. So we've already purchased this asset, and it's helped us earn revenue throughout the year. So now we just need to recognize the expense of having those supplies. So we need to calculate how many supplies have we used, and we'll expense them out. Or it could be, again, rent or insurance, anything that we've paid up front for, okay? So in this case, it's insurance. The prepaid insurance account has a beginning balance of $4,500 and was debited for $16,600 of premiums paid during the year. Okay, so let's look at that first. Okay. What type of account is prepaid insurance? Asset. Good. So prepaid insurance is an asset. And so we know we debit it to increase it. Okay, that's on the left. So it's telling us at the beginning of this year it had a balance of $4,500. That's just the balance, beginning balance, or BB for short. And then the account was also debited for $16,600 of premiums paid during the year. So we debited it another $16,600. So that's how much we've had throughout the whole year in prepaid insurance. Okay. Now it says we want to journalize the adjusting entry required at the end of the year, assuming the amount of unexpired insurance is equal to $5,600. So what that's telling me is at the end of this period, I have a balance in my prepaid insurance of $5,600. Okay. This is my balance. Well, obviously those don't equal, right? Those are two different amounts. So what I would do is I would add these two together to figure out how much my total insurance was, which is like $21,100. So all total in the period, I had $21,100 worth of prepaid insurance. At the end of the period, I still have $5,600 left in this account that's still an asset. So what I want to do in my adjusting entry is show how much insurance I used and expense it out. Okay. Well, if I had $21,100 and at the end I'm left with $5,600, how much did I use? $15,500. Very good. So I know I need to credit as an adjusting entry $15,500 to my insurance account. So then I had total debits of $21,100 minus the credit of $15,500 gets me to that balance of $5,600. Okay. So we're going back to chapter 2 here and looking at balancing T accounts, right? So make sure, you know, I bring scrap paper when you're doing the project, and homework and the test, because drawing out these T accounts can sometimes really help make sense of it, okay, to me, and I think hopefully to you all as well. But you can visualize, okay, this is how much we had total in prepaid insurance. This is my ending balance, so I need to credit $15,500. So I just subtracted there to get that.
Prepaid insurance and asset.
Because when you prepay it, you're paying for insurance for 5 months, 6 months, however long. If you canceled that insurance policy after a month or two, you would get money back. So it's considered an asset until it's used up. Does that make sense? So all those prepaids are considered assets until we use them. And then once we use them, we're going to expense that out. But this is how much we still have that we've paid, you know, Liberty Mutual or whomever we owe. So if we canceled the policy right now, we should be able to get that money back. So that's why it's an asset to us, because it has value.
The credit side is like how much we're paying.
That's how much we've used up of the insurance. So we paid $21,100 in insurance premiums, and we've used up $15,500 of that. So we're going to expense it out. Do what?
Premiums are payment.
Mm-hmm. Yep. So the adjusting entry here, what would I debit? If I'm showing used up insurance. Insurance expense, very good. So we're going to debit insurance expense for the $15,500. You got it, very good. And we credit prepaid insurance, the $15,500, which is that shown right there. So the debit to this is a debit to insurance expense. So remember with adjusting entries, whether it's an accrued or a deferred interest or expense, sorry, you're always debiting some type of expense account, okay? And in this case, when you're dealing with deferred expenses, you're always debiting an expense and you're going to credit an asset, okay? Any other questions on that one? So this would work the same for like prepaid rent or supplies, any prepaid accounts, okay? And then the last type, we'll still practice more, but the last type of adjustment we have is depreciation. In this book, they don't have you calculate depreciation, they give you the amount. So they're just telling us the estimated amount of depreciation on equipment for the current year is $7,700. All we have to do is show that, we have to journalize that. Again, depreciation is just the decline in value on long-term assets. So in this case, it's equipment. We're just showing the cost of actually utilizing that equipment, okay? So it's always a debit to depreciation expense, always a debit to depreciation expense, and a credit to that contra asset account, accumulated depreciation on the equipment. So remember, accumulated depreciation on equipment is a contra asset account. Contra just means opposite. So it increases on the credit side instead of the debit. And it's really just holding that decline in value. So you'll have equipment. Remember, all of your long-term assets stay on the books at their full cost. And then this accumulated depreciation is going to be credited, showing the decline in value. So on your balance sheet, you're going to show equipment minus or less accumulated depreciation, can't talk, to get the book value or what it's currently worth, okay? So they just gave us the amount, so it's $7,700. Okay, so just remember, you never credit the long-term asset itself. You always credit accumulated depreciation. And that is a contra asset account. Okay. Any questions on that one?
What is depreciation?
It's just the decline in value of the asset. So those first 5 really covered all the 5 types of adjustments that you're going to see. You know, there may be supplies instead of insurance or something like that, but we've covered the 5 types. So let's go on to the next one. And these are just more practice, you know, a little bit more balancing and things like this. So it says, this is an adjusting entry for unearned fees. When we see the word unearned fees, we know that that's a deferred revenue, okay? So it says the balance in the unearned fees account before adjustment at the end of the year is $18,000, okay? It says journalize the adjusting entry required if the amount of the unearned fees at the end of the year is $3,600. So again, we're dealing with unearned fees, which is a liability. So our beginning balance of unearned fees is a credit of $18,000. Okay. So unearned fees has a credit of $18,000, and they're telling me at the end of the year the balance should be what, $3,600? So in order to decrease that account, since it has a credit balance, I know I'm going to have to debit something. So how much am I going to debit unearned fees to get a balance of $3,600? Perfect, $14,400. And again, we just took our $18,000 minus the $3,600. So $14,400 of these unearned fees have now been earned. Okay, that's what that means. So we already know our debit, right? We're going to actually debit unearned fees, $14,400. And what would I credit? What account? Fees earned. Very good. Fees earned. So this is a deferred revenue or an unearned fee. So anytime you see unearned revenue, or that's a deferred revenue, so you're always going to debit your unearned liability account, whatever it is, and you're going to credit your actual revenue account, in this case, fees earned. Okay, so we just subtracted to get our adjustment amount. Debit unearned fees and credit fees earned.
Why are unearned revenues liabilities?
Mm-hmm.
I know I'm saying why
Because we owe them the service. They've paid us and we haven't yet done the service.
Oh,
or,
that's what that means. Okay.
Yeah. Okay, this one says adjusting entry for supplies. Well, again, an adjusting entry for a supply is considered a prepaid or deferred expense. So anytime we see a prepaid or deferred expense, I know I'm going to debit some expense account and credit an asset. In this case, it tells us the balance in supplies account before adjustment at the end of the year is $4,850. Well, we've actually looked in our supply cabinet or closet or wherever we have supplies, and we only have $880 left in supplies. Okay, so we're really just, again, balancing a T account. So we're going to look at supplies, which is an asset. So it increases on the debit side. And its balance at the before adjustment was $4,850. And we did a physical count at the end of the year, which we typically do with inventory accounts like supplies. And we have $880 of supplies left. So our balance should be $880. So how many supplies did I use in this period? Very good, 3,970. Okay, so I know I need to credit supplies $3,970. Again, we took the $4,850 minus $880. We need to credit supplies $39.70. We used $3,970 worth of supplies. Well, if we used them, that means we need to expense them. Okay. So again, we're going to debit supplies expense for the $39.70 and credit the asset supplies. Okay. So we. That's a good question. So you know what side, because we know supplies is an asset. So we know we started with 4850, and we need the ending balance to be 880, and we know that balance is a debit balance because supplies are an asset. So in order to decrease our debit balance, we have to credit it. Yeah, good question. Any other questions? All right, let's see, number 8. Okay, this is prepaid insurance. Prepaid insurance is another deferred expense. So it's really just like supplies that we just dealt with. We paid for insurance up front. We need to show how much was used. This example is showing you the wording can be different, so we just have to read carefully. It says the balance in the prepaid insurance account before adjustment is $27,000, and it wants us to journalize 2 different entries based on the information given. So in part A, it says the amount of insurance expired during the year is $20,250. Well, when they say that, when they give us the expired amount, that's how much we used. So that's actually our debit and credit amount. Okay, so if you see the word used or expired, we know that's our actual debit and credit amount. So we can actually just put that in. Okay, so you may see it either way. They may give you the ending balance like they did here with supplies, or they just may tell you, you used this much, which is always nice, right? When we don't have to calculate. So we're going to debit insurance expense and credit the asset prepaid insurance to show how much insurance was actually used up and needs to be expensed out. Okay, so if you see used or expired, you can use the number they give you. On part B, though, they tell me how much unexpired insurance is still left. Okay, that's telling me what the ending balance in my prepaid insurance should be. So that's when I'm reverting back to my T account. Okay. That's when I'm looking back here, and I said I started with 27,000 debit because it's an asset. And at the end, it should have a balance of 6,750. How much do I need to credit to prepaid insurance in that case? Yeah, the same amount, right? $20,250. They just gave it to us in 2 different ways. But we subtracted. We took 27,000 minus 6,750. And it's 20,250. So it's really the same journal entry. They just worded it 2 different ways. Okay. So just be mindful of that when you're reading through the chapter or you're doing the homework and the test, that you understand what it's telling you. Okay. Is it telling you what was actually used? And that I know is my actual debit and credit, or is it telling me the ending balance in the account and I need to find the adjustment amount? Okay. All right, let's see, we're ready. Was there a question? If it says what? Yes, yeah, if you see the word unexpired or unused or balanced, then that's when you know, okay, that's the ending amount and I need to find my adjustment. Yeah.
I get a little confused on why an expense that we have is debited, because, I mean, I feel like an expense is something that you spend, so shouldn't it be credited?
Well, remember, debits and credits don't mean increase or decrease. each account increases and decreases on either the debit or credit side. So with an expense, yeah, we're debiting it, but remember that overall is reducing our retained earnings, or, you know, and then reducing our equity. So showing an expense as a debit actually subtracts it out from our equity. Okay.
So that was like prepaid insurance is an asset, and why are we not debiting? Okay.
Yeah, we're crediting prepaid insurance to show that we've used up that amount of prepaid insurance. Yeah. So when we're crediting the asset prepaid insurance, that's showing how much we've used. So we're subtracting it out. Okay, and then yeah, that's shown as a debit to the expense account, because those expenses overall are going to be subtracted out of equity. Yeah, it all goes back to that expanded accounting equation. When you look at equity, it increases on the credit side. So when you're debiting expenses, it's decreasing equity overall. Okay, that's kind of the big picture item there. That's why expenses all get debited. Any other questions on that one? All right, let's see, we're at number 9. This one is dealing with unearned and accrued fees. So again, we're dealing with accrued and unearned fees, both. So it says the balance in the unearned fees account, and again, when I hear unearned fees, that means that's a deferred revenue, is $97,770. It's telling us of these fees, $39,750 have been earned. Okay. In addition, $24,650 of fees have been earned but not yet billed. So those are two separate situations. They've lumped it all together. Okay, these are two different types of adjustments. That first one is telling us we had unearned fees throughout the whole year of $97,770. That's a deferred revenue. We have earned, it is telling us how much has been earned, so we don't have to calculate it, right? It's actually giving us the earned amount. Of those $97,770, we have earned $39,750. So what that means is we're going to take it from an unearned fee to an earned fee. So that's a deferred revenue situation. So in part A, the unearned fees, you're truly just going to debit unearned fees and credit fees earned for the $39,750. So it just told us, in that case, we didn't have to, you know, come up with the answer. It told us how much was earned. On part B, though, it even tells us it's an accrued revenue. So in addition to that, so separate from the unearned revenue, we have $24,650 of fees that have been earned but not yet billed. So that's considered an accrued revenue. All that's saying is we have actually done the service and we haven't yet billed the client. So that goes back to that accrued revenue where you're just simply going to debit accounts receivable and credit your fees earned. Okay. So I debit accounts receivable and credit fees earned for the $24,650. So those are two different types of adjustments there. We had a deferred revenue, and then we have an accrued revenue. Again, though, both times fees earned, our revenue account is credited. So anytime the adjustment has to do with revenue, we know we're crediting revenue. You just have to figure out what you're debiting. Any questions on that one? Okay, number 10. This one's just another practice on depreciation. It says an estimated amount of depreciation on equipment for the current year is $8,200. What do I debit and credit to recognize depreciation?
You debit depreciation expense.
Perfect, good.
Credit accumulated depreciation.
Very good. So we debit depreciation expense, the $8,200 that they gave us, and we credit accumulated depreciation on the equipment of $8,200. So now we've pretty much done 2 examples of each type of different adjusting entry. Okay. And that'll move us to our last one, which is long. So I wanted to get through this one with you guys to kind of show you more of what you would do in your homework and even in the project, because you're going to be given information like this. And so we've went over the adjusting entries separately. So now let's look at, we have Reese Financial Services Company, and they're giving us the unadjusted trial balance. So these are the numbers that we got after we journalized and posted all of our transactions for the period before doing any type of adjustments. So they show us our unadjusted trial balance, which you'll be doing that on your project. You'll be doing, after you've journalized and posted all of page 5 and 6, you'll want to do an unadjusted trial balance. So again, this is just listing all the accounts and their ending debit and credit balances. You can see them all through there. And they do equal. And then the next step is it's going to want us to actually journalize the adjusting entries. Okay. Well, the tricky part of this is we might need some of these balances up in that unadjusted trial balance. Okay. So we have to kind of read through and kind of decipher what we need and what we need to do. So what we're going to do is we're going to journalize the adjusting entries, and they gave us the accounts to use: salaries and wages payable, rent revenue, insurance expense, depreciation expense on the building, depreciation expense on equipment, and supplies expense. So I know I'm using those accounts and more, but those are the new accounts to journalize these adjustments that they've listed. Okay, so as you can see, they're all journalized as of the end of the period, which in this case is July 31st. So all of them are dated July 31st. We're using drop downs to make it a little quicker and easier to do together. But you know, on the project, you'll actually be doing the actual journal entries, typing them in, and you may have some on your homework too, like that. Okay. So in this case, we're actually going to just start journalizing these adjustments that are listed here. Okay. Well, the first 2 are pretty straightforward. They're depreciation. So it says we have depreciation of building for the year. What do I debit and credit for that depreciation on the building? Very good. And we want to make sure and choose building. The first one's building. So make sure you choose depreciation expense on the building. And that was for $6,400. And what do I credit?
Accumulated depreciation.
Very good. Accumulated depreciation, again, on the building for $6,400. Okay, so that's my first one. Pretty straightforward. The second one is as well. It says we have depreciation on equipment of $2,800. So it's really the same thing, just different numbers. So we're going to do depreciation expense on the equipment, $2,800. And accumulated depreciation on the equipment is credited, $2,800. So those are both depreciation ones. And the third one tells me I have accrued salaries and wages as of July 31st of $900. Again, that's an accrued expense. So we're saying we owe them wages that we're not yet paying, okay? So anytime you see an accrued expense, we're going to debit an expense account and then credit in a liability account to show we're going to pay it later. So in this case, what expense account would we debit?
Salaries and wages.
Yep, you got it. Salaries and wages expense gets debited $900 because they told us, we didn't have to calculate it. And then I'm going to credit salaries and wages payable. So that's accrued, that's an accrued expense of wages in the period. So wages have been earned as of July 31st that we're not yet paying. So we debit salaries and wages expense and credit salaries and wages payable, $900. The next one we have tells us we have unexpired insurance, bless you, as of July 31st of $1,500. So again, we're dealing with the prepaid insurance, which we know is an asset and increases on the debit side. Well, it's telling us the balance there. We have unexpired insurance of $1,500. Well, this is when I need to look. I will scroll up, or I'm going to just look at what its beginning balance was. So I know as of the trial balance, as of July 31st, my prepaid insurance account had a debit balance of $6,000. So that's the beginning balance, or however you want to put it. If you scroll up, you'll see an unadjusted trial balance. So that's when I need that existing balance, because otherwise I don't know how to calculate how much has been used up. So I started with $6,000. I should have an ending balance of $1,500. So how much insurance did I use? $4,500. You were right. I knew what you meant, right? So that's a credit to show the insurance that's been used up. So what account do I debit? Perfect. Insurance expense gets debited, and it's for that $4,500. And then I have it on the board. I credit prepaid insurance, right? So I'm going to credit prepaid insurance, $4,500. So then it will accurately have the ending balance of $1,500.
So this, when we did the one before this example, they were just one by one.
Yes, yeah, this is looking at them instead of just kind of separating them out. This is looking at more of like a realistic, what you would do in a real company at the end of the month or end of the year. Yeah. Let's see, our next one, it says fees earned but unbilled as of July 31st are $10,200. So when I see that fees earned but unbilled, that means that's an accrued revenue. So all I need to do is recognize that we've earned that revenue. Does anyone remember with an accrued revenue, what do I debit and credit? Perfect, yeah, I'm going to debit accounts receivable and credit fees earned. Perfect. So those are accrued revenues. It's revenues I've earned but just haven't billed yet. So I'm going to show that $10,200 as earned revenue. And I'm going to debit accounts receivable because I haven't billed for it yet. I haven't been paid for it yet. Okay, so that's an accrued revenue.
Once we're done with this assignment, is there any way to go back and review it? Like look at it?
Yeah, you should be able to. You can either save and exit, and then you could open it back up like you were doing it. Or if you submit it, you should still be able to go in and view like what you submitted. Now let's see, the next one is supplies. So supplies on hand as of July 31st are $615. Well, again, it's giving me the ending balance, so I need to figure out how many supplies I used. So it's really just like the insurance. I'm going to look on that unadjusted trial balance for what I had in supplies, which was $1,725. That's the beginning balance. And then it's telling me that I have $615 at the end of the month. So how many supplies did I actually use? Very good. I subtract to get my credit amount of $1,110. Okay, so again, that's telling me I had total supplies available of $1,725, and I used $1,110 of supplies. So what do I debit? Yeah, very good. Supplies expense, 1,110, and then uncrediting supplies. And then my last adjustment tells me that my rent unearned at the end of July is $300. Well, unearned rent is unearned revenue. That's a deferred revenue. So they're telling me my ending balance. So again, I need to look at what's currently in my unearned rent. So that is on my unadjusted trial balance. I should see an unearned rent, which is a liability. So it increases on the credit side. The current balance is $3,600. And they're telling me at the end of the month, it should just be a balance of $300 left. So how much unearned rent is now actually earned? $3,300. Good. So again, we subtract. And that lets me know that I need to debit unearned rent $3,300. Well, that's 1/2 of my transaction. What do I credit? What does it become? Rent revenue. Good. So that unearned rent is now earned $3,300. We have total unearned rent of $3,600. We know the ending balance should be $300. So we subtract, and that tells us how much rent we've actually earned. Any questions on those adjustments? So now what we want to do is do what we call an adjusted trial balance. So any account that we've debited or credited in those adjustments, the balance is going to change. But if we didn't debit or credit it, it'll stay the same as it was on this unadjusted trial balance. So we're going to look at the unadjusted trial balance. We're going to look at what we debited and credited and figure out our new balances. So we'll go in the same order. So we start with cash. Did we debit or credit cash? No. And you shouldn't. With adjustments, cash should never be touched in your adjusting entries. So it stays as a debit balance of $10,200. Accounts receivable. Did we debit or credit accounts receivable? Yeah. Yes, we did. So we had a balance in accounts receivable of $34,750. What did we do to accounts receivable? Very good. So we had an existing debit of $34,750, and we debited it $10,200. So since they're both debits, I know I need to add those together to get my new accounts receivable balance. And we would show all of this in our ledger. You know, we're just skipping we're not doing the ledger to save time. But you would actually be, after you journalized all of those, you would be posting all those to the ledger and updating your account balances. So these new balances should be in your ledger. Our next one is prepaid insurance. Prepaid insurance. Well, it started at $1,500. Did we do anything to prepaid? Or I'm sorry, what did it start at? $6,000. Wrong thing. I'm looking at the wrong one. I just gave you the answer. We started as a debit balance of $6,000. What did we do to prepaid insurance? Credited it. $4,500, right? It's on the board. So its new balance should be a debit of $1,500. Okay, so it has a debit balance of $1,500. Supplies are our next one. Again, it's on the board. We started with $1,725. We adjusted out $1,110. So there's our new balance. It should have a new debit balance of $615. Okay. Our next account is land. Should anything happen to land? No. Remember, land stays on our books at the cost we paid, the price we paid, until we sell it or dispose of it. So land stays a debit balance of $50,000. How about building? Have we done anything to building?
No.
Nope. So it's going to stay on the books as $155,750. $155,750. Well, then we have accumulated depreciation, bless you, on the building, and we know it's a credit. Its original amount was $62,850. Did we do anything to accumulated depreciation? Yes, we did. And we credited it, right? For $6,400. So we started with a balance of $62,850, and that was a credit balance, and we credited it $6,400. We're just going to add that together. What's my new accumulated depreciation? Very good, $69,250. So we started with the original credit balance and then added in our credit of $6,400. Next we have equipment. Has its balance changed? No. So it stays on the books at $45,000. And then we have its accumulated depreciation. So accumulated depreciation on equipment. And it changed just like building, right? So it had an existing credit balance of $17,650. And then we added another credit of $2,800. So what's my accumulated depreciation on my equipment? Very good, $20,450. So we added the unadjusted balance plus the credit that we did on the second adjusting entry. What's next? Accounts payable. Did we do anything to accounts payable? No. So it has a balance of $3,750. Your adjustments shouldn't touch accounts payable either. It should always just stay the same. Our next liability account is unearned rent. Unearned rent. Did it change at all? Yes, it sure did, didn't it? We have it here on the board. So it started at $3,600. We adjusted out $3,300 of it. So it has an ending credit balance of $300. So an unearned rent should have an ending credit balance of $300. Well, we have a new liability that wasn't on our unadjusted. We now have salaries and wages payable, so it needs to be listed with our liabilities. So I have salaries and wages payable. And we actually credited it $900. It didn't have an existing balance, so it now has a credit balance of $900. Then we get into our equity accounts. We have common stock. Did anything happen to common stock? Nope. So it stays a $60,000 credit. We should never do any adjustments to it. How about retained earnings? Anything happen to it? Nope. So it should be $93,550 credit balance. $93,550. It's never touched by adjustments either. How about dividends? No. So it has an existing $8,000 balance, and that's a debit balance. Again, it won't ever be affected by adjustments. How about fees earned? Fees earned has been adjusted, hasn't it? So it originally had a credit balance of 158,600. 158,600, and then we had, let's see, we had a credit to it for 10,020 or 200, sorry. 10,200, and I think that was actually it, wasn't it? Because the other revenue was in our rent revenue. So it should be 168,800. So fees earned is 168,800. Rent revenue is a new revenue account, so I'm going to list it next. We have rent revenue. And we know in our last adjustment, we credited it 3,300. So it has a credit balance of 3,300. 3,300. Now we get down to all of our expenses. So the first one we have listed is salaries and wages expense. Well, did we do anything to it? Yeah. We sure did. So we started with 56,850, and then we debited it an additional 900. Good. So what's my new salaries and wages expense balance? Very good. 57,750. 57,750. My next expense is utilities expense. Did anything happen to it? No. So it just stays at 14,100. How about advertising? No, nothing happened there. So advertising stays at 7,500. 7,500. And here's where we can start kind of adding in. I really just go by, when I click the drop down, the next expense that pops up, because it doesn't list them all in order. So the next one that I see is depreciation expense on the building. Well, we didn't have that on our unadjusted trial balance. So I would just look for my debit to depreciation expense on the building. And that was 6,400. 6,400. The next expense I see is repairs expense. Did anything happen to repairs expense? No. No. So that stays on the books as a debit, 6,100. 6,100. Yes. Yeah, advertising stayed on at 7,500. And the next one that pops up is insurance expense. Insurance expense. Well, we started with nothing. So how much did we change insurance expense? Should have had a debit, right? 4,500. That was our insurance expense. So insurance expense has a debit of 4,500. 4,500. The next expense that pops up is depreciation expense on the equipment. We had no existing balance, so I know I debited it 2,800 in this period. 2,800. Then we have supplies expense. Well, supplies expense, we knew we did an adjustment for $1,110. It was not on my existing trial balance, so my supplies expense was $1,110. $1,110. And then last but not least, we have miscellaneous expense. And it had no adjustments to it, so it's $4,025. So once you've adjusted all the necessary balances, you would just go back in and add up, I know it's long, all of your debits, and you should get $420,300. $420,300. And if you add up all your credits, you should also get $420,300. So debits and credits do match up. And that one's rather long, but I wanted to show you how it worked through a whole accounting period at the end when you're doing all of your adjustments. Again, you would usually post to the ledger in there as well, and you could get all of these balances from your ledger, but this is kind of a simplified version.
Is there gonna be like something like that on the test?
Not that long,
Okay.
yeah. you may see some adjustments, but it won't be that lengthy, because that one takes some time. If we did that, it would be the test, right? Do what? Prepaid insurance. Well, the insurance expense is $4,500, and then your prepaid insurance should be $1,500.